Hey, are you thinking about getting started in self storage? Well, the way you set up your self storage business entity can have a huge impact on whether you make it or you break it in the long term. Listen, starting a self storage business is a fantastic opportunity, but before you start building or buying units, you need to make sure you're setting up the right structure for your business. The entities you choose and how you take title and how you manage your operations can all have a huge impact on your bottom line, your legal protection, and your long term success. So, in this video, what I'm going to do is I'm going to guide you through everything you need to know about setting up your self storage business. We'll talk about why it's essential to take title in an LLC, the benefits of running a management company separately from your LLC, and how the right tax status can save you money and headaches down the road. So, whether you're just getting started or you're looking to restructure your existing self storage business, this information is going to be key to protecting your investment and ensuring a smooth operation. All right, let's get started. Okay, so how do we want to structure this business to make sure we're reducing our taxes and protecting our self storage assets? Well, what it typically looks like is a twofold or threefold structure to actually achieve all the benefits we can. So, what am I referring to? Well, number one, what I like to do is I like to start first with a Delaware limited liability company as a holding LLC here. Now, a lot of my videos I talk about using Wyoming for anonymity, but when it comes to self storage, you're typically going to be financing it through a commercial loan. And I've just found that commercial lenders prefer to see a Delaware Holding LLC versus a Wyoming LLC. Now, why is that? Well, you have to talk to the lender. But in my personal experience of doing these deals, Delaware has made that happen much quicker than using Wyoming. So the second thing we'll do then is we'll create a asset specific LLC in the state where the self storage activity is going to take place or where that asset is located. So let's assume that mine's going to be in Oklahoma. So I'll create an Oklahoma limited liability company here to take title to that asset. Now, this Oklahoma LLC will be owned 100% by my Delaware limited liability company. So here's the thing about this entire structure here. Let's assume that there are two of you involved in this investment. So what I'm going to do with the Delaware LLC, I'll typically structure this as a partnership for federal tax purposes. Okay, so that's going to be a partnership, and then the Oklahoma LLC up here is going to be disregarded. Now, the only time you should not structure it this way, know this is really important, is that if you're buying this property and your intention is you want to go in, you want to stabilize it, you want to do some things to increase its overall value, get the rents up on the property, and then you want to flip it. So this is maybe you've got a 3 to 5 year time horizon there. In that case, what I would recommend you do is just set up a Delaware LLC and don't even use this and file the Delaware LLC in the state where the asset's located. And then make sure that it's taxed as a partnership. But if you're going to hold this long term, right? This is a legacy investment. And I'm going to, hold on to this for 10, 20, 30 years. Then I would set up this Oklahoma LLC and disregard it to the Delaware LLC. Now, if you're wondering, I'm kind of confused here. Why did he take me down this rabbit hole? Some of you might be thinking, very simple. It comes down to selling the property. So if my time horizon here is under 5 years, okay, so this is a flip deal. Okay, so if it's under 5 years because I want to flip it, then I want to make sure that I have a tax return on the entity that actually holds the property. This will help me on the sale. I've seen investors before make this one mistake that they set up the entity as disregarded. And then when it comes to selling, it's hard for the buyer to obtain financing because there isn't a tax return associated with the title holding entity. So if it's a flip property, you want there to be a tax return associated with the title holding entity. And that's why if it's a flip, then I'm going to do this. I'm going to buy it in the Delaware LLC that is foreign filed in the state where the asset is located. But if it's not a flip, then that is not my concern. So if it's not a flip, then I'm just going to set up an Oklahoma LLC, in my example, owned 100% by the Delaware LLC. And that Oklahoma LLC will be disregarded. Now, because these are set up this way, partnership, disregarded, or strictly partnership, this is all flow through. And what that means to you as the investor, if your self-storage unit generates $200,000 after all expenses, then that $200,000 is going to show up on your 1040. You will pay tax on it. Now, one of the things that we like to do here at Anderson when we're working with people, and if you'd like to get a strategy session to talk about it with your portfolio, is we want to find ways to reduce the taxable income that flows out to you. Click on the link that I'm putting up here on the screen right now, or you can go to that link and we can schedule a free strategy session to show you how to reduce your taxes. And I'm going to show you exactly what I'm referring to in just a moment. Because this money that flows down to your 1040, as I stated, that's all taxable. So what we want to do is shift it. We want to get it off your 1040 or get a portion of that. And the strategy that is often overlooked by individual investors, and one that I like to use, and it fits really well with investment real estate and self-storage, is to set up a management entity. We're going to set up a management LLC. Now, this management LLC is going to be treated as a C corporation for federal tax purposes. And what that means is that unlike the flow through stuff over here on the left-hand side of my screen that's flowing down to me, this entity here, any income it earned that it doesn't expense out is going to be taxed at a flat 21%. Now, I like 21% taxation because it's lower than my individual income tax bracket. So just think about this for a minute. If your self-storage business or any other business that you had made $200,000 after expenses, and you didn't want to pay taxes on that money, but you wanted to have access to it so you could use it in a way that benefits you, that is non-taxable, this isn't going to help. But if you paid a management fee, if I paid a management fee over here to my management entity, let's say I paid a management fee of $60,000 this year. That ends up reducing my tax liability from 200,000 down to taxes only on $140,000. So that 60,000 now is over here in the management entity, and that if I don't do anything with it, it'll be taxed at a flat 21%, which is lower than my personal bracket. So it means I have more money left over after taxes. I can just borrow it out of that entity if I need it. But most likely what you're going to do is you're going to expense it out. Now, I'm not going to go into all the ways in which you can expense out money out of your management arm. But if you want to learn strategies on how to do that, I'd love to have you attend one of our tax and asset protection workshops. Are completely free. They're one-day events. In fact, if you go into the show notes, there is a link on how you can register for that. And we teach you how you can use this type of structure to cut your tax liability significantly. Okay, so by doing this, what you're going to do is you're going to set up a management agreement. So this management agreement is going to be in place where this entity here is managing the self-storage property. And so all of the people who come that want to rent the spaces, they're going to deal with this one management arm. So they're going to go to the management arm, they're going to pay it, and the management arm is then going to handle all of the leasing out activities that a normal property management entity would handle. But instead of using rental real estate, and again, it works really well for rental real estate as well, it's going to be doing that on the self-storage side. So that's how I would typically structure this. Now, there's another way to put this deal together, and I want you to consider this as well. You see, in the management structure, this LLC that owns the property is still responsible. If something were to go on, say somebody came to the property late at night and they're assaulted by a person that's there while they're checking on their own unit, they're going to sue. Now, they would sue the management arm, and they're probably going to sue this entity as well that owns the property because it's a landlord. And they would say, hey, or the owner of the property, you're going to be responsible for the lighting. Now, what I like to do in lawsuits is I try to structure our clients so that we limit their overall liability exposure by giving them arguments to take their title holding entity and remove it from the possible claim. Right? We don't want them to go after where the asset is located because that can tie up that asset and then get a judgment against it. Then they can easily get paid when the property is sold or when it's refinanced. So another way to structure this deal here is that when you've got your structure in place, here's my Delaware company here, LLC. Here's my property holding LLC. I don't actual property itself. What I'm going to do over here now, when I create my business arm, my PM is what I referred to it, instead of entering into a property management agreement, I am going to enter into a lease agreement where I agree to lease the property to this entity here. And so this entity now, its business is running a self-storage business. So it's subleasing it out. And so I put all these people on notice that, hey, we're subleasing this asset. I'm a middleman here. I'm responsible for managing all this asset. I sublease it from the landlord. They have nothing to do with it. All liability runs to me. So now if something were to happen, they come after this company here, and we try to keep this one out of it because of that lease agreement and putting everyone on notice that this entity here is the one that they're dealing with, and it's the one that's leasing them the property, and it has a lease agreement with the owner to do that. And so I kind of like that strategy as well, from a liability standpoint. So I'm always looking for arguments that we can use to prevent someone, as I stated, from getting after our assets. Now, there's another strategy as well that you could implement, if you're so inclined to really tie this up and make it even more unattractive to a potential creditor. And that strategy has to do with a friendly lien. If you want to learn more about that particular strategy, then again, I invite you to that tax and asset protection event that we teach, where we go into that particular strategy on how you can create a friendly lien to tie up the equity. So if somebody's looking at your asset, they're going to think, hey, there's nothing to go after here. I'm not even going to touch that. It's a whole other level of asset protection, and it's so easy to implement. I'm surprised that more people are not doing it. Guys, if you like this video, be sure to hit the like button. If you're not yet a subscriber, now's your opportunity to get the most up-to-date information when it comes to tax and asset protection planning for real estate investors delivered to your inbox each time I drop a new video.